The market seems to not be really worried about the budget. They're more focused on the data and the prospect of the Fed being on hold and inflation being too low. So no, financing hasn't been an issue, and my guess is in the short run it won't be.
Partly, Andrew, because of what Joe said. Inflation is quote unquote too low. Interest rates are extremely low, and Germany just helped us out with that, didn't they? I mean, what would our interest rates be if German bonds weren't basically negative again?
Well, they'd probably be higher, I think. But the point of this is that where interest rates are validates a higher multiple on the market, and that's why you're seeing some strength today.
Yeah, we're seeing 300 points or so to the upside if you take Boeing out of it. Joe, I'll go to you on that as well. I mean, how can we take for granted that European debt is going to be as moribund as it is, and therefore the 10-year yield, you could argue, is divorced from U.S. economic prospects? What do you make of the fact that wage growth has been so remarkable?
So on the wage side, wages have been relatively weak, Kelly, because productivity's been weak. But on the U.S. side for rates, U.S. 10-year yields are actually high relative to most of the globe. But that's, of course, because of Europe, as you mentioned, has very low rates. Much of the German yield curve is negative. And as long as the ECB continues with this extraordinary stimulus, which it just said it will through this year, that's going to cap the ability of 10-year yields to rise. I expect 10-year yields to stay comfortably below 3%. And that probably means we could do a lot more on the fiscal side for infrastructure and things of that sort.
You know, Andrew, in the notes that I have here, you're mentioning to our segment producer that a lot of things in the market indicated that a pause was on tap, that the breadth was weakening, the transports looked terrible, the small caps looked very bad, and these are patterns that we've seen for the past couple of weeks. And yet here we are today, very strong in the markets, thanks to big cap technology. We had that Apple upgrade, we had a Facebook upgrade, we have semiconductors really rallying today. Does this really show you that this is a big cap tech kind of market? As long as you have that leadership, the markets are all right.
Yeah, absolutely. Look, I think on the negative, the biggest negative for the market is that 75% of the market, the companies that buying back their stock, the window will close by the end of this week. That's the biggest buyer stocks will not be in buying because it's leading up to the quarter. The positives is that two things happened Friday and yesterday. On Friday, we had a weak employment number. The market actually does better when we have weak employment numbers than when we have very strong employment numbers. And then you had Fed Chairman Powell say he's not going to raise rates anytime soon. So I think that's a very powerful combination. So we have this battle going on in the market between the Fed causing the P to go up, but we have some earnings revisions that are going down. Right now the market's focused on the former, not the latter.